Well, hello, Internet, and welcome to part 5 of my Python for Finance tutorial series. Of course, anytime you do a tutorial on the stock market, of course, people are going to start asking, how do you predict the future price of stocks? Well, one of the ways to provide insight on where a stock is going is you can use something called regression analysis. And in this video, I'm going to cover regression analysis in great detail. I'm going to take you through writing all of this code, and I'm going to explain all of it and what all of it means. And what we're actually doing here is time series analysis, which is just a form of regression analysis. You're going to be able to plug in a stock, like for example, I plugged in Google, and you can see here that we are going to train our model based off of the price movements of Google over about a year and a half. And then you're going to see the actual prices, and then we're going to make predictions. And the green line here is my prediction for where Google's stock was going to go. And the blue line represents, from this point on, the actual movements of Google's stock price. So you can see in the near term, regression analysis is pretty accurate for the most part. And if you are able to provide regression analysis on numerous different stocks, it provides many opportunities for you to further investigate using chart patterns to find out some great investments. And I have a lot to do, so let's get into it. All right, so now I'm going to teach you about regression analysis and how it can help us make predictions on the movements of securities. Okay, so what we have here is the same imports that we've had previously. And every single line of code, everything you see here is available in the description along with a folder with all of my stocks. Now we're going to need a couple new imports here for doing regressions. What we're going to need is StatsModels, which is a great library we can use to run regressions. And I'm going to get that and abbreviate it as SM. And also I am going to get Seaborn, and it extends the capabilities for plotting with Matplotlib. Okay, so we have both of those. And here are some other different constants. You may need to load Seaborn and StatsModels inside of Anaconda. If you don't have that, in previous parts of this video tutorial, I showed you how to do that. And then you're going to have your path. If you're on Mac, you're going to have a certain path. And if you're on Windows, you're going to have a different path. I am now on a Macintosh, so I'm going to change my path there. We're not really going to do that much with dates in this one. And then I'm going to have to create a new function that's going to return a data frame from a CSV file because we're doing different types of stuff. So I am going to call this just get df from CSV. And I'm going to go over some multiple examples of what regressions are and how they work. And you can go ahead and read this as I go through here and type all this, or just follow along. Okay, so we're trying to read data, so there could be a potential problem. Of course, that's why we are trying to catch any exceptions that may occur. So I'll put my path inside of here. Yours is most definitely different. And then it is a CSV file, of course. And what's different here is we're going to, from the beginning, mark the date column as being the index. And then we need to call parse dates, and nothing is changing about our data or our stocks we're working with other than this. And then we will say except, and the error that we can expect is a file not found error, and that would be triggered if you're looking for a specific ticker that you don't have a stock for. And in this situation, I'm just going to type pass, which just means don't do anything. And you could print out there, of course, something like file doesn't exist or something like that, which would be good. All right, and then we will return our data frame. Now, regression analysis is used to examine the relationship between two or more variables. I'm going to show you two examples here, and then I'm going to show you how to use regression analysis to make predictions on stock prices. Okay, so what we're going to do is we're going to see what matters, different factors and such matter most in regards to how they affect what we are studying. And we're going to be referring to two different types of variables or things we will be analyzing. We will have a dependent variable, which is what we want to better understand. What do we want to better understand with stocks? Well, we want to understand what the future price for that stock may be. And independent variables are different variables that affect that stock price. And whenever we're analyzing stocks, of course, like I said, the dependent variable is going to be the price. That's what we want to know more about. While independent things are going to be such as previous price fluctuations, seasonality, different economic events, earnings, and so forth and so on. So let me show you an example here. Now what I have is I downloaded a data set. And what it's going to do is it's going to evaluate whether the attractiveness of a professor has anything to do with the teacher evaluations. So that's what this does. It just downloads a data set, and it is teacher ratings. And what we're going to do with regression analysis is we are going to plot a scatter plot, which is then going to generate a regression line. And you can see it right here. So here is the different beauty factors for all of the different professors. And then here is the evaluation the professors received from 2 to 5. And this is the regression line. And what it is basically just trying to find a mean average between the beauty factor of the professor and the overall evaluation. Now, if we look at this specific example, we can see here that it's rather inconclusive because the slope is not that great. Now, I would say that beauty has some effect on the evaluation of professors. However, it's not 100% sure, and it's something we would want to research further. Now, let's look at another example. All right, so in this situation, again, I'm loading a data set, and my hypothesis is that the total bill has a great effect on the amount of tip that a waiter or waitress could expect. So again, I'm just saying the total bill is going to be on the y-axis. On the x-axis, we're going to have the tip amount. And then we have to define the intercept, that is where the regression line is going to touch our axes. And we are going to be using what is called ordinary least squares for our regression. And what it does, again, is estimates the data so that a line can be drawn through. It goes and basically makes a line that is the average of all of the data points. And you can see in this situation that yes, indeed, this slope is quite pronounced. And this would hint at the fact that yes, indeed, the total cost of the bill definitely has an influence on how much tip a waiter or waitress would receive. Okay, so that's just a couple examples of just how regression lines are drawn by bringing these data points downwards and bringing these data points upwards to create this regression line. And you can see multiple examples there. But what we are interested in is stocks. So what we're going to do is that anytime we are trying to make forecasts about any type of data, but in regards to stocks, we are going to use different models depending upon the type of data that we have. And what we're going to do is we are going to train our model on the first group of data. This is referred to as training data, and it is normally the first 80% of all of the data that you have. And what we'll specifically be looking at is price fluctuations with securities or with stocks. Then what we're going to do after that is using that model we generated, we're going to test it using the last part of our data to see if it looks accurate or not. And all along, we're going to be modeling everything and making predictions and comparisons using real data. And these specific forecasts are going to be based off of trends that are analyzed with the data that you provide. And whenever it makes predictions, will those predictions definitely happen? Absolutely not. However, they are more likely to happen barring any major events such as wars or pandemics. So that is really what we're doing. We're using these models to make specific predictions on stock prices that are likely to occur. Now, we are going to be using what is specifically called the ARIMA model, and this stands for Auto-Regressive Integrated Moving Average. And it's going to be the basis for many different models. And what it does is it focuses on trying to fit the data as well as possible by examining differences between values instead of the values themselves. And science has found that ARIMA works very well when data values have a clear trend and seasonality. And it's just very important to make sure that you're aware that these predictions are going to be based off of previous events, and we cannot, of course, make any predictions in regards to unforeseen events. All right, so let's just get in here now and let's go and actually create a analysis tool that we can use to make predictions about stocks. All right, so the very first thing I'm going to call this a DataFrame is equal to, and I'm going to say get DataFrame from CSV, and I'm going to specifically look at Google. All right, so this is what we're going to be analyzing. Now, whenever I do this, I need to set that my data is going to be based off of daily information, and you define that by defining the frequency. So I'm going to say that this is daily prices. Another thing I need to do, I could come in here and go df and index like this, and whoops, and I have a little bit of an error here. I typed in all capital letters instead of TRUE. So, whoops, TURE. There we go. And let's go and run it again. And you can see here is all of our data. And you can see that the frequency is set for day. And of course, this is the date. Okay, so that is just verifying that, yes, indeed, we have set this to daily data that we will be analyzing. Now, something else you could do, or should do, is you should go in and fill in any missing values that, your data may have. And we'll just call this fill NA. And this is going to fill in any missing values based using the other information that surrounds that data. Okay, so we got that set. And up next, if you look at our specific data here, so we'll go ADF. All right, so we have an unnamed column here, and we're only going to be interested in the adjusted closing price. We're not interested in daily return. So what I want to do is go and drop off the unnamed column. So how I do that is go ADF and columns and ADF dot columns dot str dot contains, and then you just say unnamed is specifically what we're looking to get rid of, and case is going to be equal to false. Don't put that in uppercase like I did. And let's go down to the next line. Axes is going to be equal to 1. And in place just makes everything go into effect immediately with our data. And if we do this, we will see that we no longer have that. So what else do I want to do? Well, I also want to get rid of the daily return. So let's get rid of that also. So I'm going to go ATF dot drop and daily. I'll just type in the exact name, daily return, and again, axes equal to 1. And again, if we come in and look at our, you can see that it's gone also. All right, so there we go. That's how to get rid of columns of information that you do not want. Now what we need to do is I'm just going to set some basic styling for our Seaborn plots here. So I'm going to say set and style, and I'm just going to use I have an entire tutorial on Seaborn. You can find it also in the description, and I'm just going to use one of the themes, which is dark grid. Then what I need to do is add automatic date time converters. So plotting register mat plot lib converters. I need to define the size of the plot that I'm going to display on the screen. And I'll just call this figure. And then I define figure, size, and it's going to depend upon the size of your monitor. 19 by 13 works pretty good for me if I want to fill the entire screen with the plot. Then I need to define the figure and the axes that we will use for plotting. So I say, whoops, it's just plot like that, and subplots. There we go. And then I'm going to need to define the optimum, what are called lags. All right, now there's going to be periods of time in which we will not have any data because we're analyzing it on a daily basis. So when are there going to be lags? Well, there's going to be lags on the weekends, of course. So the lag period is normally going to be 1 to 2. But we can come in here and we can have this guy go and actually figure it out for us. And we will be specifically, well, let's come in here. I need to do another import. So let's do it up here. I'm going to say from StatsModels.tsa.ar auto regression. That's what this stands for. Model. And I'm going to specifically import auto regression. And I'm also going to get this guy, which is going to select, there's auto regression select order. Okay, so now down inside of our lag area, I'm going to go AR, and this just keeps us from having to do calculations and analysis. This is going to look at the data and it's going to tell me the lags on its own. And just pass in your data. And let's say I know our max lag is not going to be anywhere near 30, but I'm just going to throw it in there. All right, and now we're going to be able to use that data to create our model. And so we're going to say model is equal to auto reg and a underscore df and adjusted close. And then we're going to pass in our lags and auto regression lag, exactly like that. Then we need to fit our model. So we'll say, call this model fit is equal to model dot fit like this. And then we need to define our training and our testing periods. So what days, what number of days are we going to use for testing, and what number of days are we going to use for training. So I'm going to go A, DF, and figure out what this length is. Whoops, got a little bug. It's AR lags like that. And you can see here that we have 1,690 different data points. So we are going to go and get approximately 80 of those and use those for training, and the rest are going to be used for our testing. So I'm just going to go 16 and 90, and we can go 80% of that, which is going to be equal to 1352. And then we don't even need to go and get the 20%. We'll be able to work with that. Okay, so what we're going to do now is go and define our training period. So training data frame is equal to, go and get our data frame with all of our price information. And I normally skip the first 50, and then I am going, it seems like I get better results that way. So I'm going to say 1352, and then I need to define my testing data frame equal to ADF, and go and get everything that follows 1352. So we'll say 1352 and onwards from there. And that is going to represent the last 20%. Okay, so we have all that set. Now what we need to do is define a training model, and I'm going to use it, I'm going to say, well, let's just play around. You play around with this stuff and try to match your model up as close as possible to during your training period, and then that's going to give you better results in regards to making predictions. So regression ADF, and we are specifically interested in adjusted close. And I'm going to start this off at, let's say, 500 and fit, and COV and type is going to be equal to, and in this specific situation, we are going to be using White's covariance estimator, and I've talked about covariance multiple different times. So you just go HCO. Then I need to define the start and the end for my predictions. So I'm going to go start is equal to length and train df, and end is going to be equal to the length of my training data frame plus the length of my test data frame minus 1, of course. Then the prediction is found by going and calling train model and predict, define start as the start that you created here and end as the end, and mark dynamic as being equal to true. Now what I want to do is I want to plot my testing data with predictions, and they'll all be different colors so that I can tell what is real data and what is going to be the training data and what's going to be the prediction data. So I'll say plot and set AX be equal to AX, and this is going to be in orange, and then this is the testing phase, obviously. Then I'm going to have my prediction plot, and again you just say AX equal to AX. This is going to be probably in green, and then I'm going to have my forecast, and I'll call train model predict, and again define start. Start is equal to end. We're going to start at the end of our data, and then let's say that I want to go and make a prediction for stock prices 160 days into the future. All right, you normally don't do it that far into the future, but that's what we're going to do here. And then I'm going to come in and create my forecast plot, and we can see how it works out. So plot, and again define the axes, and let's run it. And you can see right here that my training isn't really that great, because the training should be just about absolutely perfectly aligned with this. You can see here is the blue line is the actual movements of our security. This is the Google stock price changes. And then you can see here is my starting with the green. So if I zoom in here, you can see this is my prediction. So I trained up to this very point, and then this is my prediction in green for what Google's stock price was going to do into the future. And blue is actually what it really did do. Now, what you're going to want to do here, anytime that your training data is not lining up really well with the actual price data, that means you need to change it. So what we're going to specifically change is your training model. So you're just going to use more samples. So if I want to, I'm just guessing here, I'm going to take this up to 800. And I'm going to see where this goes and see if it better aligns with my training. And if I run it, you can see it does. So now, almost perfectly, the oranges in the training data, just like the regression lines that we saw before, don't perfectly match up with the data. This is the training period. It doesn't perfectly match up either. And you can see now we are getting into making the overall predictions, and you can see here that everything, all of the data is lining up really well. You have to understand also that during the training period, the pandemic hit. So that is within our training data here, and of course it's having some effect. And I tried to cut some of that effect out by moving the this up to 50. But you can see here is the predictions, and you can see that the trends go downwards. But overall, if you look at the overall trend line for Google's stock price, it is most definitely going to be sloping upwards. So while regression analysis is not going to, be 100% accurate, what we can value in it is the fact that depending upon what this slope is for this prediction, and the greater the slope is, that is definitely going to tell us, hey, this stock should be analyzed further using other things such as chart pattern analysis to decide if this is a great investment for you. All right, so this isn't any type of investment recommendation. However, I think that regression analysis is highly valuable for anyone who would look to invest in the stock market. All right, so there you go. And like always, please leave your questions and comments down below. Otherwise, till next time.